So in this current segment, we'll be walking you through internal and swing structure and how traders can utilize them to improve the trading setups. So a typical textbook example on market structure is that on a downtrend, there's a series of lower highs and lower lows being formed, where there's a continual break in structure to form a new low, consistently to continue the ongoing trend. When the structure attempts to shift, there's a change in character, followed by a corresponding break in structure to the upside to ensure that the trend shift has been confirmed. In this current textbook example, we can see that the highs and the lows are very distinct, right? And it's very clear to everybody the current ongoing trend is. But yet in reality, this isn't always the case. In the real world TradingView example, we can see that markets are very fractal and it can form a series of highs and lows. And this, as a result, can confuse traders as they may struggle to know what the ongoing trend is. So this is where external or swing structure as well as internal structure come to play, because by knowing the kind of structure that's involved, traders do not lose sight of what the ongoing trend is, and therefore they are still better informed to time their trades properly and still maximize the risk reward as best as they can. So how do we exactly draw a swing structure? So basically we are starting off at this point, right? When there's a break of this low, which is the previous ongoing swing low, a new low is formed. And this break of the new low will thereby confirm this new swing high. So when price were to retrace at this point, technically the trading range for the trading swing range will occur from here to here. So anywhere from here to here is fair game, where as long as price don't move out of this range, the overall trend is still technically bearish, right, on the downtrend. Whereas in the internal structure, it can be a bullish trend. So how do we exactly confirm this high? Is when there's a break of this new low again to form a new swing low at the bottom, which confirms this high, right? So technically, swing structures is only confirmed when it has broken the previous established swing structure, where of course this swing low is confirmed when of course there's a break of this structure which forms this high as well, and this high again is confirmed when this swing structure has been broken. But at the same time, when this swing high has been broken instead, for a chop to happen, change in character to happen, we can see that there's a potential shift in the structure. But this high here isn't exactly confirmed yet. This high and low isn't exactly confirmed until a fake chop happens from here, where instead of coming upside, it forms down to form a new low, or either that it forms up again to form a new high. And how do we exactly apply it? This is how we can see that it may get a bit complicated, because over here we can see that there's an internal break to the upside here. But however, after this break to the upside, there's a corresponding shift the structure to the downside. But however, as this is all still within the swing range, the previous swing range, traders might get confused and take a long from here instead. But because this level here is not a very strong, it's a weak low essentially, because this swing low didn't take out the previous swing high. Hence, entering here might still be plausible for a short scalp, but it's not plausible for intraday or swing trade, because at the end of the day, you might potentially counter trending over here at an inappropriate level, since internal structure is against you and external structure is also against you. So over here, the reason why this trade will be valid, there are basically three confidences that we can confirm. Number one, the most clear-cut one would be there's a break of the internal structure to the downside, right? Number two, this order flow aligns with the swing structure, where this is a certified swing high, which price is the expectational order flow is that price will break this swing low, this high will hold. And the last confidence is that it is at a supply zone or at a premium zone where price is good for sales. So next, of course, when price has already broken this swing structure, a retracement is technically due, right? Because the market is fractal in nature. Hence, right, like let's say if price were to be around here, it'd be pretty foolish to take sales to go short, because price do need to retrace and your trading range is all the way here. So this area is technically not a premium zone in the first place. In fact, it is a discount zone of the current link itself. So in this case, when there's a break in this internal structure and price comes back here to have a demand at the demand zone, at the discount zone, this is a very long trade here because it is technically at the discount zone of this current leg itself. That's one of the confluence that we can look at. Number two, there's a internal break in structure to the upside. And number three, it falls very beautifully at a discount zone or the demand zone here. So this is where we can potentially enter another trade, where at the very least, we can at least hold till this internal range liquidity has been swept, right? Because this is where there's potential buy side liquidity that price will potentially go to before deciding where it wants to go. Does price wants to continue the downtrend, or does price wants to flag up to proceed to form a new change in character and the corresponding breakout structure to the upside. So until that happens, of course, that's unconfirmed. Hence, a safe TP would be over here. So likewise, of course, when there's a break in the internal structure here, we can clearly see that the ongoing internal trend has aligned itself to the swing structure or the external trend as well. Hence, this is an ideal sell entry here. Again, the same typical confluence are the same. Break in the internal structure, it is at a supply zone or a premium zone. And lastly, it aligns itself with the external structure. So this is a valid sell, right? So at the same time, with regards to this bullish entry that is ideal as well for a counter trend trade, we can see that based on external structure, this is technically at the discount zone of this range itself. So entering buys here would be pretty valid, right? Along with this breaking structure and at a discount zone or at a demand level. 1 and 3 is basically our pro-trend moves, as our overall external trend is a downtrend, where internal structure aligns with external trend. And 2 and 4 are basic counter trend moves, where the internal structure order flow shifts to the upside and it is at a discount zone of the previous range. So with the essence of time, I have marked out the external swing points as well as the demand supply zones. So first off, we'll start with conventionally the bull trend moves. Because as traders, conventionally, we should be only trading bull trends to get higher quality setups, right? Because if you are going with the wave, the trend, you are more likely to hold the trade longer and thereby have a higher risk-reward ratio as a result. In this current swing points here, right, we can clearly see that the ongoing trend is relatively bullish, right? Where there's a series of higher highs and higher lows being formed. So this is where, of course, we have a couple of long potential right here. Right here is one. Then we have another one, which is over here as well, along this demand zone, right, to the next swing high. So at this count level, when price hits here, right, prior to this, the external structures are just following very closely, very well, where price are just constantly breaking. There's one impulse move, that's about it. But what if in this typical scenario where there isn't an impulse move, where price range accordingly? So we can see briefly that at this current level, right, our internal structure is technically still aligned, right? There's a breaking structure here, there's a breaking structure here as well to the upside. So whenever the price hits a certain demand zone here, you can utilize these, right? Because technically your internal structure and your swing structure is still aligned. So this is some examples where, of course, we can just take pro-change move number 1 over here, and then we can enter it right here as well. So this is a clear-cut example where your internal structure, there's a break in this internal structure here. So you could have easily have entered a first entry at this point, and you can target this previous high because technically this high is a big high since it didn't break the low, right? So confluence number 1 would be internal structure broken to the upside. This is technically a discount zone for buys to go long, right? So internal structure aligned with the external structure, you can go long. So let's find another example of a pro-trend move, right? So like at this point as well, right? We can see right here that, of course, over here, there is a break in the structure here to the upside, right? So technically your swing structure is from here all the way to here, right? So when price hits at this point again, it's a bit scary to take a trade here basically, because at this very point, there's a real shot that there's a real chance, of course, for these lows to get taken out, right? Since this demand zone did help hole number 1, hole number 2, and there's a break in this internal structure again. So right here, of course, our internal structure has indeed aligned together with the external structure, because external structure, there's a break here as well. So whatever happens here, technically, this is your swing range. So any price action that happens here is all internal range, right? So if you want to take a trade here, this is potentially possible, but it's still risky because your internal order flow is still bearish by this point. It's only when there's a break in the structure here, right? and there's a big internal structure somewhere here that price order flow has officially shifted to the upside. And this is where we can potentially go long from to target this previous high as well. Okay, so we can see that the risk reward is pretty good. It's at 8, around 8 around there. The best, normally the 8+ setup comes in when we are taking bull trend moves and we are taking it into account where even the internal structure aligns with our external structure, and this is where we can potentially maximize our risk reward as best as possible. Of course, this next ongoing level here might be a bit more basic because there isn't much internal structure to begin with, and price did very smoothly, came all the way down to this demand zone to continue the trend to the upside. But by then, by the time price reached this level here already, we can see a very clear distinct higher highs and higher lows being formed by this level. But then, how about in the other scenario where now instead of a bull trend move, what if we want to take counter trend moves? So a perfect example could be over here, right? Because right, even though over here there is a break to the upside here, this is where it's a bull trend because your internal structure aligns with our external structure by this very point. But then like what if from this level here, technically the swing position, the swing range is from this high all the way till it could be here, it could be here. So there are basically potential levels where we can target as a result. So when there's an internal structure break to the downside here and here, when price is at this current level, there's a potential where we can target these liquidity zones and these liquidity zones, right? Because this is where some money are available for price to continue to move to the upside. So this is a perfect example. I believe this could be a spike up. It could be formed from some news event. But what matters is that you can potentially find an entry here and cover this high to be safe, to secure a safe level, right? So some of the confluence here could be there's a break in the internal structure to the downside. There's a liquidity that's being present over here. It is at the premium zone for sell, ideal for sell. And lastly, the next confluence could be here as well. There's this liquidity present here and there's this liquidity present here. Okay, let's look for one more example for a counter trend move. So this could be it as well, like at this level, right? Because we can see over here that the general trend might have shifted to the upside where there is this could be a chalk, this could be a change in character over here. And lastly, there's a break in structure at this level here as well to form a new high. However, of course, as you can see here, right, like that, there's a break in structure to the downside, break in structure 1, break in structure 2 as well. So, and the third break in structure number 3. So with all these liquidity present here, liquidity 1, liquidity 2 present, and a demand zone here, it is very plausible for us to take a sell trade from this level here to target all of this zone right here. So we can potentially target this low, which sweep all this internal range liquidity before price shifts back up to the upside, and we can continue to go longs right from here where it is a bull trend move essentially. Alright, so just a brief recap. Generally, we'll take bull trend moves as traders, where on a downtrend, we'll take from the lower high, and for a downtrend, we'll take from a higher low, right? So the very A+ setup is when internal structure aligns with our external structure, where in this case, when there's an internal break in the structure to the downside, it allows it to be traced at a premium zone, and this is where we can smoothly enter a trade past this swing low. So likewise, in this third example, it's the same thing where internal structure gets broken here. It realigns back to our premium zone or our supply level here, and we can ride it past this swing zone. If we are to take counter trends in this scenario, it is normally best if we wait for a break in the internal structure to the upside and let it retrace back to a discount zone. And this is where we can enter a buy from here. At the very least, it sweeps this internal range liquidity and hits discount level as well, which is the swing level, right? And at the same time here is the same thing where there's a break in the internal structure to the upside. We can potentially go longs to clear this internal range liquidity as well. So some of the things to note is that we generally have to be consistently aware of the ongoing external trend. Because let's say if you are taking a trend internally which aligns with the external trend, you know that you are able to hold for more risk reward ratio. But at the same time, if you are taking counter trends move, you have to be more conservative by where you take profit as a result. Of course, this is to note that it's not a standalone concept and we have to use it together with other concepts which we have learned, mainly the premium discount zone, which I mentioned a couple of times. How we check these levels, it can be the feed levels. And lastly, of course, is order blocks as well. to our respective supply and demand zones. Of course, there are more other concepts that we can incorporate it. But that's the end of the current section. I hope you guys have take away something from this session, and do like, comment, share, and subscribe. And I hope to see you again soon. Thank you.